Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's Tuesday, February the 6th, and happy second day of the month. Hope all of you have good romantic plans with your loved ones next week. I'll wish you an early happy Valentine's Day, and thank you for being on the call. And let's go ahead and just get started here. Get my clicker to work. Here we go. Just as a reminder, the power of the pattern is your 28-second solution, and what we mean by that is that we just one of my biggest desires. It doesn't matter if I have one chart or 30 in a report to get to you. That as you look at each chart, you can see just in a blink of an eye. Here's what the chart pattern looks like. Here's the action to take. Here's the risk management tactics along with it, and you can move along. And I know all of you are very busy, and I appreciate all of your membership. I just want to thank you for we've had a fantastic many months, but we also had a beautiful and a blessed start to the new year. We closed a couple of dozen trades in the positive side. The market in the last couple of days have despite some of the action, gave back a good part of January, but we didn't. And so I want to thank you for your membership and your encouraging notes. It's always fun to see when I get emails from you. It's very humbling to hear that, hey, I had my best month ever. And that's what we're here for. We're not trying to turn anybody into puppets on a string, but we're trying to share ideas, assets, pattern analysis, and risk management tools. And so it's been fantastic. I look for a really wonderful rest of 2018. I continue to think, just like it has for months and months, the opportunities have been fantastic, and we've been blessed, and I don't see any reason for that to change, whatsoever. So again, a great start, everyone, and congratulations to all of you that did the trades that worked out so well. This was an email or a chart that I sent pre-market this morning when it was looking at like the Dow would be off 500 points or whatever at the beginning due to the pre-market stuff. But I just shared that I thought 25.88 right in that area could be a potential support zone. You can see why I came up with it. This is essentially the last 2 years. This is a weekly chart, so you can see that we hit the top of this pattern 2 weeks ago, and so there was a test potentially this morning that it could test that. So this was the pre-market chart, and then here was the chart towards the end of the day. And so we took a shot of that support could come into play at 25.88, and you can see at the upper part of this chart that this was the print low for the day at 25.93. So the S&P came within just a fraction of that target, and then you can see for the most part there was a reversal wick. So this is just really microscopic. But I want to share one of the reasons I thought the market could reverse, and whoops. So we'll go back to this next slide. And so I thought this just kind of reminded me of the last couple of days, probably for a lot of people, around the world. But one of the reasons that I thought this morning the market could reverse was due to our good friends at CNBC. This is a chart of last night, or after the market closed, they broadcast that they were going to start or have a broadcast last night of markets in turmoil. And I found on the internet of the different times, these red circles represent when CNBC had done markets in turmoil shows after the marketplace. So I just kind of thought it was ironic that most of these occurred much closer to lows than highs. And I guess all we could do is prayer that they ought to do some shows of markets in excess, and maybe that would help us know when to walk away or something. So another really a microscopic piece that kind of went along with the first chart that I sent to you pre-market this morning. This is a look at, I've been starting off the global dashboards and the sectors report for the most part with the Semiconductor Index. Hope you aren't bored with it, but this is one of the leading indicators, and I'm well aware, and I know all of you are too, that a sector that's a leader for a while doesn't mean there'll be a leader forever. But the Semiconductor Index, and this is the ETF SMH, has been a leader since the 2009 lows, and it is testing the 2000.com highs as we speak. And so it's, as you've seen week after week, we see that it has overhead resistance and strong rising support in play. And so again, this is a weekly chart, and you can see right here that this would encompass the first 2 days of the week, that you can see that it tried to break down this rising channel. It hit these lows around the 97 level, and then it pushed back up and it closed back inside of this rising channel. That this short-term one's just a little bit over a year old, probably what, 13, 14 months. So it didn't penetrate on a close, the bottom of this. So I'm still of the take that this, the breakout or the breakdown of this could highly influence the broad market and obviously the NASDAQ going forward. So a nice test so far of rising support and a bullish reversal taking place in this leadership so far at this time. A couple of weeks ago, I started sending all of you just a couple, it was just wasn't a report, but just a couple of things that I was keeping my eye on that I thought had a little funny smell to them, that just weren't quite as bullish as some things were had been for a while. And some of these things caused me to harvest a few more of the positions and raise the stops, all the tighter. So I kind of want to go back to those. This was a chart that I sent to all of you on January the 24th. So we're just looking at a couple of weeks ago, not quite that. And this was an overlay. In the orange at the very top is the Dow Transports. The dark line is the Dow Jones, and the bottom line is the Dow Utilities. And this is obviously a short-term snapshot, but this at that time encompassed the month of January, or up to the 3rd week. And the thing that had caught my attention was obviously that the utilities were really stinking it up. You can see in the lower right that utilities at this time were down almost 500 basis points, or 5% on the month. Dow Jones Transports in the orange were still up, but you can see that they were starting to create some lower highs, and they were starting to act weak. And one of the Charles Dow created the Dow theory, and in a way, let's just not try to overcomplicate it, but if you think of the Dow Jones Industrials, the Dow Jones Transports, and the Dow Jones Utilities, it's obvious that if you can get them all to act in unison, you have a really strong market. And so this was just a little bit of something I was smelling that didn't really smell the best for the bullish case, because you saw this big deterioration in utilities. You saw lower highs and a breakdown that was starting in transports. And so this is something that I'll just continue to do. This is not a reason to become bearish, but all of these things that I try to share with you has to do with risk management. And I'll have to humbly say, when I was in the financial planning business for over a quarter of a century, I knew all my customers personally, and I knew their risk management, knew their assets, their goals, their wishes, and what they had and where they wanted to go. And I don't have that privilege anymore, so I can just try to do my best to share little things to help you, so that you can make your own risk management decisions on size of positions to take, and stops. But I'm just trying to share with you what I'm doing on my own, and I know we're all I'm 60, and to some of you young people, you probably think I'm 80 or 90, but I'm still young at heart. But I'm going to continue to show these type of things. Another thing that I sent a couple of weeks ago was, this is the equal weight cap weight ratio. This is RSP divided by SPX. And what you want to do from a bullish case, bulls prefer to see this going up. And why would you want that to be? Is you want the majority of stocks going up in the S&P versus just a few. And so what this declining ratio would suggest to you is that fewer and fewer stocks are powering this market to all-time highs. And that makes it just to be a little more selective. It's okay from an indice perspective, but if you're trying to pick some individual shares, that just means fewer and fewer are going up, so you better be even better and better in your choices in what you're doing. And I feel blessed that of the couple dozen positions that we closed last month, over 3/4 of them were to the plus side, and of the negative ones that we had, we controlled. Is what we were trying to do, is really control the risk management to the downside, because it's obviously easy to recover just from a really small nick or scrape. So just as a reminder, as we try to start off each webinar, I'm not a bull or a bear. I am bullish on opportunities, regardless of whether it's a commodity, yields, bonds, gold, you name it. Our whole goal is to find some asset that's moving from the lower left of the chart to the upper right, and that could be an inverse ETF. So I don't care how you look at it. I'm just trying to be bullish on opportunities, and I'm not trying to wear a bull or a bear hat, feeling great or poor about the economy. So when I send these type of messages, that something stinks a little bit, that doesn't mean to become bearish. It all has to do with risk management. So the chart on the left, you can see up here, sent this on January the 29th, and this was a daily advanced decline line. And my favorite is the big picture, 30,000 foot view on the advanced decline. But I want to just kind of show you on a really micro basis that we were seeing some choppiness. So you can see just right in here, which was over a 3-week time period, not a lot of advancement, nothing like what we had seen. And then when I sent this to you on January the 29th, we could see that it was having a little bit of deterioration of rising support. So the chart on the right is the same chart. I just didn't do any technical analysis, but you can see it at that time, the reading or the indicator was around 93,400, and right now you can see it's 80,600. And so when I sent this chart, to you, it was up in this range, and so it's deteriorated, quite a bit in a short period of time. And so these are some things that I just always hope to show you on a micro basis to be aware of, that I hope can help you with some of your decisions. But looking back from the 30,000 foot view, this is the advanced decline line, common stocks only on the New York Stock Exchange. And you can see that this is in a strong upward trend, which has helped me. I'll just have to say personally, this is one of the most important charts because, you can almost look at any other chart out there, but if you can see how the advanced decline line's doing and believe in it as I do, this can help you so much in your positioning and whether to be long, neutral, or out. So the only thing that is not bearish but does have me concerned, as I've tried to share over and over, is this is really a steep rising trend, which just shows how strong the market has been. But it is testing the top of this rising channel. So nothing negative has come out of this, but this really is a place that if you're a bull, you really don't want to see selling start here. Because the last time that some selling started here was back in 14 and 15, and you can see that once it started sputtering, it had actually then didn't go much of anywhere for almost a year and a half. So, I don't think that, the advanced decline line is the best asset to try to do technical analysis on, but I do feel that trend analysis and kind of just getting a picture of it is a good idea. So again, this is still in a very positive rising market, but again, and we'll discuss it even more, this isn't a place, or it would be concerning to me if we started seeing some weakness take place at the top of this channel. Just a little update on the weekly advanced decline line. On a much closer basis, you can see that this is a rising channel that's been taking place for about 15 months or so. And so the decline over the last couple of weeks has actually taken it down to rising support. So the trend is still in play, support and support until broken. The bullish case to me would get a cautionary message if you would see a rising support break in the upper right. So last Friday, I traveled over the weekend and I put together the sectors report early, and I just kind of wanted to go over a few things that we're going to discuss today. It's the trend, and despite let's just go back to last week. Let's go back before the 700-point decline on Monday. Let's go back before the 1,000-point decline on, last Friday was a 700, 1,000 on Monday, and a 500-point rally today. Let's just go back to last Thursday before any of that happened. So we'll just go back in time. We'll do Michael J. Fox, whatever, the Back to the Future movie. And so we're back here last week. And so I still want, none of this is going to have changed, but this is still, Joe Friday, just the facts. This is a 90-year chart on the S&P, and the momentum is the most overbought ever in the last 90 years. So, again, we're back at last Thursday. We were sailing along. The market's still doing well, but this is something that is still extended like we've never seen, before. Another piece that was in the sectors report is this is the U.S. Financial Condition Index shared by Goldman Sachs and Goldman Sachs, excuse me. And what this just shares is the Financial Conditions Index is in blue, the S&P is in gold, but you can see how high it was in 2000. And so we'd had the rally through the 1990s, which elevated this index. And then once it was at high, it started to roll over. That's where the markets started to roll over. But the key was bargains come when this financial index is low. You can see the 2003 the bottom in the index and the S&P. Then it rallied back up. It had a little bit of a lower high, but again, it was close to the 2000 level, and that's when the S&P struggled again, and then it became deeply overvalued. And now we're back at 2000 levels again. So this isn't bearish, and this doesn't mean that the current trend is going to end. But as I've shared many times before, this is typically not where new long-term bull markets get started. If we'd say, okay, let's put 100 grand in right here at this price point in the upper chart, what are the odds that 100,000 is worth more money 3 to 5 years from now? Well, I bet somewhere along the line that puppy's going to struggle, and you're going to want to have applied some active management to it. So again, not bearish, but just be aware that these financial conditions index are extremely lofty. This is almost on the flip side. This is the cash balances available as far as the S&P 500 market cap. So you can see when this chart's actually almost the polar opposite. When it's low, it reflects that there's very little fuel left to be able to push the markets higher. This is not a bullish or bearish indicator, but it's just kind of where does the macro picture stand as far as fuel to push it higher. So you can see how low it was in 2000. Here's 2006. Those were both highs in the marketplace. And then you can see the low in the marketplace where there was a lot of cash or a lot of fuel, and hence we've seen 9 years up in a row when this was at the highest level as far as the most fuel, going back clear to the 1980s. This is when I got into the business. So you can see in 2009, the cash level was the most conducive for a long-term rally at that time. So here we are right now at 3, which reflects a low number, lower than 2006, but not as quite as low as 2000 itself. On the flip side, this is the equity short interest, cash plus ETFs. Just wanted to kind of share that, again, when this indicator is low, the markets are typically lofty. Here was the 2007 peak. Here was the opportunity at the 2009 lows. And then you can see currently that, again, this indicator is reflecting some extremes. That's typically not where new bull markets get started, but it does not mean that the current trend has to end. Another one just to look at, and this was in the sector's report, is the momentum and risk appetites. It's at levels that are seldom seen in the last almost 30 years. You can see in the upper right, it's actually at the highest level. Here was 2009 when real bargain opportunities come into play. So again, this is not bearish, but I just always want you to keep this perspective. Like I said, let's go back to last Thursday before any of the last few days took place. You just need to be aware from sizing of positions and stops where some of these indicators are. The amount of available cash to fund managers is extremely low. This is going back 50 years. The red dots reflect when cash is low and then where the markets were. 1968, the S&P didn't go anywhere for measly 10 or 12 years when these cash levels were low at that time. Here was in the late 80s. Then here was 1999 and the 2003 bottom. So you can see it's not as low as any of those others, but there's not a lot of extra cash that these mutual fund managers have on the side. So here's what I want to kind of talk about today that I think is important. I don't think it's a 1,000-point decline in the Dow yesterday is important, or is it? Is it important that the VIX blasted off yesterday? Is it important that the VIX fell hard today? Is it important that XIV is going to go out of business today? Or they declared that it's going to go out of business in a couple of weeks? Or is it important that it had a 500-point rally in the Dow today? Actually, what I want to talk about today is really none of those. I want to talk about the current conditions and where some of the selling got started. You may get bored with it, but we're going to continue to go over some of this. Is when the trends are up, there are certain price points that if you have the bullish case, you don't want to see selling start. because then that's where selling can bring about more selling. We want to see breakouts, not selling start. So I just kind of want to remind some things. This is the Dow going back 100 years, and this is a Dow on a monthly basis. So let's just look at the top part only. That's the relative momentum on a monthly basis, which, you know, it kind of looks like an EKG, everyone. It kind of goes up and down, but this thing doesn't move real rapidly. But the point that gets my attention is how lofty the level is in the upper right. And then when we look back over 100 years, there's only 4 other times that the market momentum reached these levels. 1929, around 55, 1987, and 2000. We can see 2007 was fairly close, you know, here, but not quite as high. So 3 of these 4 from a momentum index ended up being some fairly significant, important highs in the market. So this doesn't, again, mean the trend's got to stop. But then we go and look at this rising channel. And what I did, everyone, is I took the lows of the early 40s, the early 50s, the Nixon impeachment, the 50% decline in the 70s, the late 80s. I got into the business right here. This is when the Dow was below 1,000. Sir John Templeton said, you know, I don't think we'll ever see these low prices again. And, you know, it'd been sideways for, you know, 15, 18 years. PE ratios, I mean, geez, I think the PE, the dividend yield was higher than the PE ratio, just stuff that I don't know if we'll ever see again, or that I'll ever live long enough. And, but boy, you know, the values were great. But here was obviously rising support. So I took this support line and did a parallel to create the channel and laid it on the 1929 high, and lo and behold, you can see the 2000.coms came up here and hit that. And then we started rolling kind of sideways, and we're back at testing the 70-year channel again. So none of this means that the trend has changed anything, but the trend's still up, right? It is, but here's where we don't want to see selling start. This would be one concerning case. We want a breakout here being long and strong, not selling starts, selling get started, excuse me. So again, just the takeaway from here, trend's still up, testing the top of a 70-year rising channel with monthly momentum is at a level that's only been this high 4 other times in 100 years. So a similar look to the S&P, not quite as long, you know, the Dow or the S&P hadn't been around quite as long as the Dow, but this does go back 30 years, and it's on a monthly basis. So you can see that what I just took the 87 high and took the lows. This is when the rocket ship really took off in 1994. This was right after the Saddam Hussein became a household name. You can see the financial crisis lows at 2009. So here's the bottom of a rising channel, did a copy paste parallel channel. You can see the 2000s, and then we hit it last month. Also, an 8-year rising channel is taking place. So 2 different breakout tests. The trend is solidly up, hitting a breakout test with momentum at one of the highest levels in the last 30 years. So again, nothing bearish here, but the trend is up. But the whole point of today is, where could selling start that could be concerning to the bullish case? So a couple of days over the last few weeks hasn't proven a thing, but these are the type of places that the bullish case doesn't want to see selling continue. Transportation, another short-term chart. I'm just kidding. This is another 30-year snapshot. Quality rising channel, no doubt about it. Triple breakout test taking place a few weeks ago at 1. As we started off the presentation, as I started kind of alerting you a couple of weeks ago, transportations were reflecting some weakness before one of the other indices. You know, the utilities was ahead of it, but you can see this breakout test was in play. Then we've seen the decline that's taken place, and then we have quality rising support off of what a almost a 4-year rising support line in place at 2. So the bulls would prefer not to see selling take place here, and for sure would get a concerning message if support would break at 2. But right now, 4-year support is in play for a very key index, being the transportation index. Another one that we have been sharing each week from a long-term perspective is Japan. They peaked in 1989 up here. They hit a low in 2009, 20 years later. So there's two things that I'm going to continue to update that have my attention a lot. Is the two different shades here is the Nikkei index is at the 50% retracement level, which comes into play at 23,295. And also you can see this green rising shade, that this is a rising channel, and it's also testing the top of that. Now this chart is also on a monthly basis, so you can see right in here, this last month, there was a reversal pattern or a reversal wick that took place right at dual resistance, and then we've seen some softness. So again, this is another asset that the trend is up, but this is a price point that the bulls don't want to see selling get started, because this is, if selling would continue, this is where it could start to kind of snowballing on more selling, could bring about more selling. So another long-term rising breakout test with momentum that's very, very, very lofty. Another one that, you know, it'll just be interesting. I think the odds are low, but the, you know, one of my favorite phrases is the odds may be low that I'm correct here, but the impact would be huge. So this is the Dow Jones on a monthly basis. And what I did is I took the monthly closing high right here at 1 in 2007. And we've been including this in the global dashboard every week for a year and a half. This is the monthly closing low in 2009, where we applied the Fibonacci extension level. So nothing fancy here, folks, that we're taking the distance between. I mean, I've got to say, you know, when you look back over the last 11 years, and if I'd say, what are the two most emotional price points in the last 11 years, I truly, you know, my heart believe the answer is 2007, the emotional high, and the 2009 is the emotional low. So let's just tie Fibonacci to that. And then the first extension level would be taking this whole price move and then adding another 61% to it. So you'd have the 161 level. Well, that 161 level came into play in the Dow at what, 15, 16, 17, about 18,000. And so, folks, when it came up and hit that level, what did it do? It's kind of hard to believe now. It's if you maybe it's just going to get older. You know, go to sleep at night and forget some stuff. But you know, folks, if you look, this thing didn't make much progress from 2014 to the end of 16. So it's like almost 20 months that it chopped sideways. Now in the rearview mirror, its chopping sideways was building an upper level base to break out of. And so you can see that it broke above it, used the old highs that it had been playing around with for over a year and a half as old resistance became new support. And then when it broke out, the rocket ship just took off. So the reason, you know, that this is important, you know, is that these extension levels off such key emotional highs and lows can provide resistance points. And, you know, but once that broke out, you know, we really were trying to hop on the bandwagon with trades and stuff to the upside. And the reason that I want to really talk about this is a lot is we're right back at another one. So this is the Dow again, tying the intra-month high and low in 2007 and 9 and applying the Fibonacci 261. So this is taking the distance of these two emotional highs and lows and adding a 261% expansion. We've been putting this in the reports every week, and that comes into play around 26,700. So nothing is proven, but I still, it could be fascinating in time, is that the Dow got within 0.5% of this 261 level, and weakness started creeping into the market. Now, could it blow it out here by this Friday, or, you know, in 6 weeks from now? And the answer is absolutely yes. But remember, the last time it hit the 161 level, it did this for 20 months. So this is why I say you don't want to see selling get started at these key breakout levels or these key Fibonacci extension price points. From the positive is if they can break out and of either a rising channel or an extension level, is hop on that pony and ride it. Ride it for all it's worth. But this is a point that I'm trying to just kind of get ahead of the curve. Remember, wasn't it Wayne Gretzky said, don't skate to where the puck is, skate to where it's going. I'm trying to help you to where things may be going. So these could be really important levels for the market. Again, Dow 26,700 is really important. If you can get above there, obviously, man, this trend would really attract you to more money. But again, to me, this is a little bit of an overhead resistance level, that the 161 level was for 20 months. We'll see if the Dow, if it's a big level for it or not going forward. Another thing that's kind of stinking a little bit from a bullish case, that I want you to be aware of is, junk bonds are essentially stocks in drag, or in other words, they're imitators. And so this is the ETF JNK. So JNK, in its own way, has been diverging for about a year. And why I say that is, as the market's been going up, it hasn't been going up. It's been mostly flat. You can see a series since last summer of lower highs, but essentially been in this trading range. And as of the last few weeks, this is one of the pieces that I sent to you from the bullish case. This smells a little bit that you could see some selling pressure come into the market because of the message coming from junk bonds. That was last week, a pretty good size decline. Obviously, this week is testing the bottom of the 2007 trading range, and you can see in the top part that relative momentum continues to create a series of lower highs and is actually breaking the 2007 lows at 2 above. So this is not exactly what bulls want to see from a situation that that all of us can just sit back, sit Bahama Mamas, be in long positions, and forget the market completely. This is not the type of environment right now, or so far, that lends to that type of a strategy. So one of the things that gets my attention is passive versus active, and what do I mean by that is, there's always been the debate of should you just buy an indice on the index, or should you try to be a little bit more active in your portfolio? And the answer, a really easy answer, is, well, it just kind of depends. If you're going into 2000 through 1990, it was really active. It was really an easy answer to say, yep, sure want to be passive, because in the rearview mirror it went up 9 years in a row. And if you're in 2003 and the S&P, you held on to what you had, well, you lost 50% of the gain. You said, well, maybe in retrospect I should have been active. Well, then from 2003 to 2007, it went up, 6 years in a row, and all of a sudden, then passive is back again, buy and hold, and then we had the financial crisis, and so it's kind of back and forth. Well, now we've had, 9 years up in a row. Only one other time in history has it ever been up 9 in a row. 1929 was only up 8 in a row. So we do have something, unique. So just kind of wanted to talk about this just for a little bit. And, I looked up in the dictionary, what's passive mean? It says accepting or allowing what happens or what others do without active response or resistance. And so today, I really think it's ultra important, especially after 9 years up in a row. Nothing that's happened in the last couple of weeks has broken long-term trends. But I think we may have to be, especially like with the Fibonacci 261 extension level, we may want to be a little bit more open-minded to being active going forward than what we've been. And one of the things when you think of crowded trades, I found this of interest. This is a chart of fund flows towards passive funds or active funds. And so you can see in 2008 and 9, kind of where it stood, you could kind of started to see a trend that people were pulling money out of the active type thing. They were loading up on buy and hold, and then all of a sudden they were wrong, because in reality it should have been the other way around. If you think about it, everyone, in hindsight, in 2009, when you was going to have 9 years up in a row, that was the time to pile into the passive side, just to sip the Bahama Mamas and hold all that stuff. But you can really see that passively money has just been flowing to the billions into the passive funds, just by the low-cost index, and you'd be perfectly fine and get away from the active side. And so, by nature, not always right with it. I'm a contrarian at heart. I was highly influenced by, Sir John Templeton. That as great as he was fundamentally, he was just a great observer of human behaviors. And so I want to share stuff like this, with you that, kind of like I said, going back to 2009, that would have been the time just to load up on the passive side. And now I'd really make the case that I bet the people that are pulling out of the active side in time, a few years from now, may regret that. Just another piece of this kind of the same bent. This is passive mutual funds and ETF flows. You can see over the last few years that in the last just very short time frame, in the month of January, people just plunked a ton of money, into the passive ETFs and mutual funds. And I can only imagine what some of those people that bought lately are have a little bit of sweaty armpits the last couple of weeks. No different than when a few people came out when Bitcoin, even CNBC, when Bitcoin was at 19,000 in December, they started showing, here's how you buy Bitcoin. Well, might have been better off to show, here's how to buy Bitcoin at 1,000 versus showing it at 20,000, when earlier today the thing hit 6,000. So it was, what would that be, down maybe 60-70% since they did that piece. So I always love the contrarian side of things. So I kind of want to show you that in time, these huge inflows to the passive style may end up regretting that a little bit. So here's one that in September of 2011, I threw this. I thought the world would probably greet me like this gentleman in the upper left, like, expletives, and Chris, you got to be crazy, for saying this, and I probably was. But this is a multi. This is hard to believe, but everyone, this is a monthly chart going essentially back to 1980. So we have almost 40 years on this gold chart. But what I did was I took the high in 1980 here in gold around 850, and then the low in the late 1990s, around 1999, and applied Fibonacci to it. Well, after this long of a bear market and this much of a decline, gold took off, and it didn't go up for 1, 2, or 3, or 4. It went up 10 consecutive years in a row. And similar to where the Dow is, right now, going back to 2011, gold was hitting its 261 extension level. So in other words, when we took these highs and lows, this was 261% above this whole range. And so at that time in September 2011, I shared, with this gentleman that there's a good chance, due to certain conditions, that gold could be flat to down for years to come. And it was a low odds of being true. But my job is to not try to be friends. It's to stretch your mind, to encourage you to have an open mind, and to maybe share opportunities that could be from a contrary perspective. So that ended up being a good idea, because essentially what that was saying is that the passive endorsement of owning gold had become very, very high. Hey, it's going up every year. Why be active in it? Well, now we've seen gold back off, lose a good percentage, 35-40% of its value. Silver still down 65% of its value. So that was a key time to move from passive to active. So one of the things that, again, probably a low odds, but it'd have a high impact, but there's some similarity here, is this is the Dow. So this is the same chart that we went through earlier. Took the 2007 highs, the 09 lows, put the 261 that comes into play at 26,000 and change. But there's a couple of parallels. We did take some extremely highs and lows. We're applying the 261, and the Dow was up 9 years in a row. And as passive became, hey, that was the thing to do in 2011, passive is the thing to do now. And so we'll just see if it's different. Will the Dow be flat to down for years to come? I think the odds of that are low. But one of the main bents of today's talk is this is the price point where you don't want to see, especially with passivity being so high, you don't want to see selling pressure start taking place. Thanks to Sean, one of our good premium members. He said, hey, Chris, Fangs is important to a lot of us. Would you please share the Fang charts, which is Facebook, Amazon, Apple, Netflix, Google, each week. And Sean, thanks for the idea. And I will be doing this now each week in the sectors report for a while. And because of the way the software is set up, it best works on a 6-pack. And so I thought maybe it'd be best to look and add the S&P in the lower right. But you can see the trend on each of these are up. Each of them have, for the most part, tested the top of short-term rising channels of late. This is a place where you don't want to see the Fangs come in and see some selling pressure take place. You can see a similar pattern even in the S&P. So there's two of them that you can see, or three, excuse me, that are testing support. You can see Facebook so far has done that this week. Apple is the most vulnerable from a break of support. If you're an Apple fan, good place here to buy it on support, as it's testing about a 1 year rising support line. You can see so far this week that it's trying to make a bullish reversal. And you can see that Google has also went from the top of its essentially 14-month rising channel to the bottom in just a couple of weeks. And so far this week, we see a bullish reversal, no different than the S&P. So the takeaway here is they're all still in bull trends. Several of them have tested their top of their rising channels and backed off. That's not where you want to see selling take place. The message would be is that if these rising channels would happen to not be supportive for these stocks, which they have so far, that would be a concerning message for the bullish case for the Fangs and also tech and the broad market. So a couple of lifting up the hood and looking underneath a little bit. This is each week in the global dashboards, our global trend report is I really love watching, and I share it each week. This is on the left is the PIMCO Junk Bond Mutual Fund. And the reason that I share this each week, folks, is that partially I'm biased to it because we used it in the late 90s, not only for ownership of my customers, but also for a tool. And when you look at JNK and HYG, which are two of the most popular junk bond ETFs, they don't have a long history. So you can't go back and look how junk bonds acted in the late 90s in either one of those, but you can here. So just an observation is, stocks want to see junk heading higher, and junk really took off from 2016, and it has been for the most part. So it's been sending a positive message to stocks. As you can see, since 2012 to 14, it's created a series of higher lows and lower lows. So now it's back at the top of that channel. Maybe potential head and shoulders top here. Regardless of that part, it came just short of retracing its 61% of the 2014 to 16 decline. So it's up to its a key Fibonacci level, up against resistance, and now it's had a series of flat bottoms and is breaking support. So from a micro perspective, this is not bearish for the broad market. But broad market or stock for the bullish case, you do want to see junk acting a little bit better than what it is here. And this is one of the pieces I started sharing with you a few weeks ago, that just from a small elements, this kind of stinks for the bullish case. So I started seeing stuff like this, started harvesting a few of the gains, pulling up some stops, and I hope you found some comfort if you followed some of those things, that the declines that we saw over the last few days, that they became more opportunistic than a problem. We didn't give back a lot of gains that we had. We booked a lot of the stuff, and now we've got, and I'm excited about it because we've got a good bit of cash, very lean in the portfolio now. Let's just see where things take us. And it's nice to see, CNBC doing the markets in turmoil and some of that stress, because that's where some opportunities could come from. So in the upper right's the Shoebox indicator, and again, this is a tool that has multiple types of credit instruments in it. And again, it's not junk bonds, but it has some overlaps, but it's different enough that it's very important to me. So you want to see the Shoebox indicator heading up. When it does, it sends a quality bullish message to stocks. When it's acting weak, it's starting to smell a little bit, which then you wouldn't be surprised to see a little bit of stock weakness come in. So this is a weekly chart, and you can see that the Shoebox indicator, it's hard to see how many bars are in here, but the Shoebox indicator started heading south towards the first of this year. So in some ways, it's not a surprise when you see this taking place to see this taking place. So now what, from a bullish case, you'd like to see is a Shoebox indicator pulling reversals and heading higher. If it continues to head south, it would send a continued diverging message against the stock market. Just a little reminder of what took place in the last couple of days. I look back on the original VIX index, which goes clear back So what we're looking at here is the quote unquote the fear index going back almost 30, well, it is 30 years. This is as far back as I could get it. And so you can see that most of this past year, a lack of volatility. And so the amazing part of the last few weeks is, we essentially was around the 10 level. And in just a matter of a couple of weeks, we went from one of the lowest levels in 30 years to one of the highest levels in 30 years. You can see the very few times, essentially in groupings 2, 3, 4, 5, 6, 7, 8, only 8 times in 30 years has volatility been that high. And then typically it tends to back off. And so the bottom chart is just kind of an overlay to remind you of the differences between when fear goes up and the S&P. But just still as a reminder that the S&P is the momentum, again, is at one of the most overbought levels in the last 30 years, and it is at the top of this very quality rising channel. But again, one of our takeaways here is the trend is still up. The last couple of weeks has not changed that, but from a bullish case, this is not where you want to see selling get started. I debated whether to show this in here, but I want to talk about this ahead of time because even in the last day or so, we saw several derivative ETFs bite the dust. One of them being XIV, and some of its kissing cousins that essentially are, as many of you could explain, better than myself, but they're very complex issues. They don't really have that many underlying assets. They're just based on a lot of mathematical formulas. But what this is looking at, folks, is it's a reminder of a story that you really want to know what you own. And with the market being where it is, if for some reason sellers would come forward and step in and selling pressure would increase, I know some of you are going to, the main strategy is if the market starts falling apart, is to avoid it, is to be in cash. And if you had $1 million in 2007 and you went in cash, and in 2009 the S&P fell 50%, and you just put it in a tin can, you still got $1 million, right? But what'd you do from a purchasing power perspective? You could pick up 50% more. So there's a lot to say for sidestepping a decline and increasing your purchasing power. Now, what's the ideal situation if we could have our cake and eat it too? You not only sidestepped it, you took advantage of a decline. But I just want to I thought this would be a fresh time to go back to a story, and the answer's right here on the page. But in the orange, in 2009, EEM, the emerging markets ETF, lost 54%. So during that time frame, you were a genius. You thought, I see this coming. I know it's going to happen. I'm going to buy the 2X inverse ETF. So the dark line is the 2X inverse ETF. And for a while, it really did well, up 140%. But also you got to know these tools that if volatility picks up and you start seeing some up and down movement, I think one of the most amazing things about that year is EEM lost 54% and the 2X inverse lost 18%. That's still better a -18 than a -54. But this is just a reminder of what we've seen in some of these derivatives or levered up ETFs. But I would just want to remind you ahead of time that if there's a day that comes that you want to short this market, that's perfectly fine if the conditions are there. I will do it some, but some of you may find me boring if I don't want to lever up. I just want to take a boring 1X position. Because one of the things about a 2X position, what it helps you do? When you're wrong, it just helps you be twice as wrong. And so there are issues, and I'm going to get off this soapbox, but I just kind of want to remind you, especially as we just see the biggest news over the last couple of days is that, it's amazing that XIV, with the market going up 567 points, that you would think XIV would just rally through the roof, and this is the day where they play the tap song and they bury it. And so again, really knowing these instruments is really key, friends, going forward, and how they act and some of the things that they're based upon. So I haven't had a chance to talk with you each personally on some of these things, but just we're going to go through a couple of extreme charts. The move over the last year and the last 56 weeks in the dollar has been fairly extreme. I know this is a busy chart, but just kind of hang with me. So the top half is just the US dollar going back, you can see, to 2001. We have almost a 20-year snapshot. And then the bottom is the 56-week performance of the US dollar, just to kind of give you some perspective. And so you can see over the last little bit over a year and a month, about 13 months, the S&P, or excuse me, the US dollar is down about 13%. And there have been how many other? So is this a rare thing? That's why I try to show these rate of performances. It helps me, and I hope it helps give you some perspective that, yeah, the dollar is down 13% in a year. Has it been down that much before? Is this a small decline, a big decline when it's fallen this much before? What's been its future returns? So you can see in the last decade, only 3 other times the US dollar has fallen this much in a year. And when it had fallen that much, these green vertical lines show where the US dollar was. So after a decline of that much, historically over the last decade, the dollar was closer to a low than a high. Now, can it fall more than that? It sure can. I mean, I should have extended this line over here because that's almost another case, and you can see that it was at a tradable low. Excuse me, that didn't stop it from some of its lows here when it was just free falling. So from a rate of return perspective, we have somewhat of an outlier going on that very few times has the dollar fallen this much over 20 years. Now, from a power of the pattern perspective, you can see that the dollar remains in a rising trend, a series of higher lows and higher highs. So it's now the decline over the last 13, 14 months has brought the dollar to rising channel support. Support is support until broken. So far, each time that's been on this line has been a good time to buy it. You can see if we take the highs in 2002, all these series of reversal lows, we have a potential support there. Plus the highs in 09 and 010 also took place at this level around 80, let's just call it 87, 88. So we've got some extremes going on, and as this was taking place, from Sentiment Trader, the number of people bullish the dollar stood at 20%. And I did this, excuse me, I shared this with you a couple of weeks ago. I just really kind of wanted to talk this out, that this is a place where the dollar could rally. And obviously that's a contrarian play. It's out of favor, but it's also, from a power of the pattern, I find it really interesting. Now, I will say support until broken. If this would break, I think the dollar is in trouble. And so this is going to have a lot of influence on decisions in the metals market. So let's see if we can just look at the polar opposite of that. So this is the euro, and we looked at a 56-week performance in the bottom, same type of a window of performance. You can see that the euro is up 18% over the past 13 months, and very few times has the euro done that over the last 14 years. And when it had rallied that much, the euro each time was closer to a high than a low. So not only do we have this outlier of a performance perspective, we also have the euro in a 9-year falling channel. It's kissing the top of the channel, where so far this has been a time to short the euro, and that's where it's peaked. And as it was kissing the underneath side of this, another crowded trade was going on, is that 83% of investors were bullish the euro. So this is fun to me to see, not only from a power of the pattern perspective, not only from a sentiment perspective, and not only from a performance perspective, some rare extremes are taking place. And so this is where some opportunities can come from. And obviously with 83% of the people bullish the euro, if it would back off, it'd surprise the majority traders around the world. And if the US dollar would rally, with only 20% of the people bullish, it would also surprise a lot of people around the world. So I thought this was kind of interesting over the last couple of weeks, or since January the 25th. Where have you been able to hide? where's been a good place, asset-wise to not lose money? And so this looks at, over the last couple of weeks, the performance of several assets. So we see the dollar is up about 140 basis points. Junk bonds down 230, gold 257, ZROZ, which is a zero coupon bond, down 360. The S&P, now this was done this morning, so this number would be smaller, but as of yesterday's close, was down 7.5%, and miners were almost down 1,000 basis points, or 10%. So ironically, over the last couple of weeks, it's not a long-term trend, but King Dollar has been a place to hide. And a lot of the traditional places, wow, stocks are going down. Maybe I can do well in bonds. Well, they haven't been a place to hide, nor has the metals, nor has junk bonds. So it's just been kind of ironic that the dollar has been a small place to hide. At least it didn't lose any money. And I think some of that had to do with the extreme decline that we just went through, the support that was in play, and very few bulls. So it's, Sir John, before he passed away, I thought he made an interesting perspective. He said, I think we live in the riskiest times in our lives. And he wasn't talking about PE ratios. He wasn't talking about the amount of money that was on margin, valuations, channels, or anything. What made him say that was that the world had become such a highly correlated place, that there was really hardly any place to diversify yourself out of risk. And this is one thing I was talking to my wife about over the last few days is, most people haven't had any, outside of cash for the dollar, haven't had many places to hide during some of this. And that even makes this marketplace, all the tougher for most people. So I hope that you can see that when we've taken profits off the table and lightened up our positions, that was our own way of trying to have a place to hide for future opportunities coming up. Another one that was kind of at an extreme, this is the yield, could be at an extreme. I should add that preface, could be. But this is the 10-year yield going back, 20 years to 1998. And so on the bottom, we look at an 80-week performance of yields. And you can see that yields spiked up from 2013 to 14. And we see this spike up again over the last 80 weeks. That the yield on the 10-year note is up, what this would mean is up 88% in the last 80 weeks. And only one other time in the last 20 years have yields shot up that much. And you can see this was late 2013. So if we would go up to that time frame, you can see that there was a peak in yields. And so I thought another interesting thing that was taking place is, let's just look at some power of the pattern perspective. We have obviously two significant emotional extremes of interest rate lows, deflationary lows in yields to where they took off here and here. So we take those 2 points, take the support, and then do a copy paste to find a trend channel and lay it upon the 2014 highs, and lo and behold, look where we are right now, testing that. So it's kind of been, I think, got to be frustrating for the bond bulls that some of the stock market weakness, that the bonds really didn't act very much as a counterbalance or a place to hide, of late. I have to humbly say that, a lot of people this month, I forgot, I'm in February. This is when I started in the business in 1980. So this is celebrating this week my 38th anniversary in the business. And so I've seen the majority from the time I bought my first mortgage at 12.5% interest rates, money markets that I was sharing with people that were brand new tools in the early 80s. They were yielding 18%. I wasn't able as a rep to give people a toaster like the bank, but boy, rates were really high then. But obviously we've seen them go lower and lower. But a lot of people have declared the death of the bond bull market. And most of these people are probably a heck of a lot smarter than myself. But I guess one of the things that just sticks out to me is, if the bond bull market is dead, one of the first things that I think needs to start is it ought to just be higher than where rates were just simply 4 years ago. And so far that's not happened. But if it does, break out above this essentially 3%, let's just call it 3% yield, on the 10-year. Then the next major resistance would be about 375. So that wouldn't be good for bonds, but we've got some extremes going on. I'm surprised that bond sentiment isn't better than what it is. And what I mean by that is there's like 40% bulls right now. And so I'm surprised. I feel really good that interest rates could reverse here if maybe there was, 10 or 15% bulls, just very few people liking bonds. But the bottom line is we've had a rare rally, and we are testing 4-year breakout levels at 1. So this could be a really big piece for what the 10-year yield does around the 3% level. Other places to potentially hide, or that have been out of favor, that I'd like to see do well. I'm not wearing my bull or bear hat, but just as a reminder, as the dollar is testing rising support, if the dollar would break rising support, historically, that'd be good for commodities. So this is an important test for commodities. Totally open-minded to not only own gold and silver, but to back the truck up after they've been so frustrated for years. But this is just a reminder of the silver-gold ratio, that to back the truck up and really to be long and strong in the metals, you want to see this ratio going up, because then the underlying poor man's metal, being silver, would be outproducing gold. So when this ratio would be going up, it's a good sign to own either or both, including the miners. But you can see right now, since the early part of 2017, and obviously for years, the ratio continues to be in a falling channel. And it continues not only to be in a falling channel, but to create a series of lower highs over the last year and a half. And this is a chance that this is a bearish descending triangle. And if it is, and it breaks support here at 3, it would suggest to stay away from metals, and it would suggest that it probably could fall a good bit further. So this, becomes always a great barometer that, as the dollar, I'm kind of surprised, everyone, that the kind of weakness that we've seen in the dollar, that we haven't seen more strength in metals. And to me, it doesn't matter what asset class it is, that when favorable conditions take place and that asset doesn't respond, it can probably even be weaker when the favorable positions leave. So again, we'd get a short-term favorable response if this ratio could head up, but right now this ratio is continuing to act weak, and it's attempting to break last summer's lows at 3. A similar look in the metals area. This is GDXJ, GDX ratio, junior miners, senior miners ratio on a weekly basis. To own the miners, you want to see this ratio heading up. So overall, when you look back over the last 8 years, we see a series of higher lows and lower lows. The big test is since 2015, we have seen some higher lows. So we have the lows of this past year and the support line coming into play at 2. So this is a big test as we see a series of lower highs, because there's a chance that this is a descending triangle right in here in a long-term falling 8-year channel. So to give an encouraging sign to the miner space, you want to see this ratio acting better. It'd be really nice to see it bounce off of rising support at 2. But if the dollar starts bouncing off its multi-year rising channel, and the miners would break support here, it continue to send the message that there's not probably a lot of opportunity on the long side of the miners. A big test for oil is at hand. I do think that rising oil is viewed positively by the stock market. Here in Kansas, is filling up our vehicles recently, and we're about $2.45, $2.50 a gallon. I've tried to share with family and friends, and I think it's better to pay in our area. I know California is just higher period, but in the Midwest, I think it's better to pay $3 than $2, because at 3, maybe it means the economic conditions are stronger. But regardless, this is crude oil. Looking back over the last 8 years, you can see a series of lower highs through here that's coming down. Crude oil has had a nice rally. Stocks have rallied along with it. When a lot of people want to say, oh, the softness lately is due to volatility, it's due to some letter that was released from the FBI or all of this nonsense. One of them could be is, have you noticed anybody that crude oil's backed off a little? And have you noticed that stocks have been heading up with crude oil? So this is a big test. The trend on crude oil is up. It is facing a breakout test. When you look above, you see that crude oil peaked obviously in 2014 at above 100 and went down into the 20s. You can see it had a series of falling momentum, and it really started turning lower. So we do see that momentum is very lofty, and on a very short-term basis is breaking rising support in the upper right. So bulls in the commodity space, in the oil space, in the energy stocks, and I believe in the broad market, do want to see support hold here, don't want to see selling start taking place. So as a reminder, I'm kind of a little more excited. Actually today, this is our list of just a reminder of strong February stocks. There's some really nice numbers in there. I've not sent any suggestions on any of these so far because of those conditions I started off with, sharing with you a couple of weeks ago that there's some stuff that stinks mildly, not like that dead fish, but they just a little bit. And I think it was good to make those observations, to not try to go into these, because for the majority, they haven't had any upward price action. They've been soft. But if some of the support levels that we looked at earlier can hold, completely open-minded, because these are some really nice strength numbers, so we can get some reversals. One of the ones that still interests me the most is, as we continue to talk about the Semiconductor Index, how we started off the presentation earlier that it's on rising support. Here's Skyworks Solutions, which is in that sector. You can see that it's touched a few times of late. It's been weak with the broad semiconductor sector. It's now had a few different, this is a weekly pattern, series of higher lows. You can see where it tried to break it, most likely yesterday. Actually yesterday, excuse me, it was up, and when the market was down, it actually reflected some relative performance in a positive way. Did have a little bit of a reversal, but I do have an alert set that if it can break out above these prior highs and get a little bit of a close, I'm interested in this stock because of the leadership role and its seasonality, and it's on long-term support. So I kind of wanted to update you that I'm watching all of those stocks, but this is one of the February seasonal stocks that has really got my eye, one of my favorites. On the flip side, this is a stock that's not on that list as we're wrapping this up, but it is a stock that's really been beaten up. Newell Brands, you can see this past summer it was trading almost at 55, created a double top. Doesn't matter the reason, but essentially it gave back half its value in a matter of a few months inside this falling channel. So a couple of weeks ago, you see a possible reversal here at the 2013 lows. And as we look back over several years, 7 or 8 years, if we go back even further, the momentum is one of the most oversold in a long time. So for those that like to try to buy low and sell high, I do have an alert set that if NWL breaks above that rising falling channel, I'm interested in being a buyer with a tight stop. So I want to thank you for your attendance today. Thank you for your membership. If I was, hey, high five on the internet for all the kind of month that we had in January. An entire year can be based upon, a lot of you I know talk about, I'd be happy if I made all those gains for a whole year that we made in January. But I personally believe in my heart that this is still going to be a fantastic year, a lot of opportunities. I do believe that being active on both sides of the fence, maybe last year there wasn't a reason to short the market at all, and right now there isn't any reason to short it, but I wouldn't be surprised if we were on a webinar a year from now that somewhere between now and excuse me, next February are a couple of opportunities to even take some advantage on that side, but the trend has not been broken by any stretch at this time. So thanks again, Rick, and I really appreciate your membership, your communications. Hope all of you have a great Valentine's, a great year. Best wishes for your health and your families. And again, thanks so much, everyone. Take care, and we'll talk to you next month.